I want you to do something before I say anything else. I want you to open whatever app or screen you normally use to track silver. Maybe it is your brokerage account. Maybe it is a silver ETF chart. Maybe it is a commodity price tracker. Look at the number it is showing you right now. It probably says somewhere around $84 per ounce. Now, I want you to understand something that most people holding silver still do not realize. That number is not the real price of silver. It is the paper price of silver, and those two things are not the same. Right now, today, March 13th, 2026, buyers in Shanghai are paying around $12 more per ounce than what your screen shows. Not $2, not $5, $12. And that gap is not a glitch. It is not some random anomaly. It is not a rounding error in the data. It is a signal that the pricing system that has controlled the silver market for decades is beginning to fracture. And once cracks begin to appear in a pricing system like this, they rarely close again. That is what this video is about. Stay with me. Before we go any further, I want to be completely clear about something. Everything I share in this video is for educational and informational purposes only. I'm not a financial advisor. I do not hold any investment licenses. Nothing in this video should be taken as financial advice or as a recommendation to buy, sell, or hold any asset. Precious metals markets are volatile. Prices move up and prices move down. You can lose money. Always do your own research, speak with a qualified financial professional, and never invest more than you're prepared to lose. I make these videos because I believe financial education matters, and because people deserve to understand how these markets actually function beneath the surface, not just the simplified version presented on financial television. With that said, if you are new here, subscribe right now and turn on notifications. What we cover on this channel is very different from most market commentary. We go into the real data, warehouse inventories, delivery numbers, institutional positioning. And today, on this Friday market close, I'm going to explain something that many retail silver investors have never had broken down clearly: the difference between the paper price of silver and the physical price of silver, and why that difference might now be the most important number in the entire silver market. Let us start from the beginning, because some of you watching this may be hearing the idea of paper silver versus physical silver for the first time. When you look up the silver price on financial websites, whether it is Yahoo Finance, Bloomberg, Kitco, or the price chart inside your brokerage app, the number you see is based on silver futures contracts traded on the COMEX exchange in New York. Each COMEX silver futures contract represents 5,000 ounces of silver. But here's the critical detail. Most of those contracts are never settled with physical metal. They are traded between banks, hedge funds, and large institutions. They are rolled forward into new contracts. They are closed out in cash. They are financial instruments. They are claims on silver, not the metal itself. That is what the market refers to as paper silver. Physical silver is something entirely different. Physical silver is the actual metal. The bars stored in vaults. The coins investors hold in safes. The silver used in solar panels, electronics, and medical devices. It has weight, it has storage costs, it has transportation costs. And because of those realities, the physical silver market and the paper silver market can sometimes behave differently. For many years, the difference between those two markets was small, maybe 1%, maybe 2%. If the gap ever widened too much, traders would step in and close it through a process called arbitrage. But what is happening right now in Shanghai suggests that this mechanism may not be working the way it normally does. Because at this moment, silver trading on the Shanghai Futures Exchange is priced roughly $12 per ounce higher than silver trading on COMEX. Earlier this week, the gap was even larger at times. Some analysts observed periods where Shanghai pricing implied silver above $96 per ounce, while COMEX contracts were trading closer to $84. Think about what that means. Buyers in the world's largest industrial market for silver are willing to pay $12 more per ounce just to secure physical metal. Not a futures contract, not a paper claim. Actual silver. In a perfectly functioning market, that kind of price gap should not exist for long. If silver were truly $12 cheaper in New York, traders would buy it there, ship it to Shanghai, and capture the difference. That is the entire purpose of arbitrage. But the fact that the gap is persisting suggests something unusual. Either the silver in New York cannot easily be delivered, or it is already committed, or moving it across markets is far more complicated than the pricing models assume. When arbitrage stops working, it means the two markets are no longer fully connected. The paper price and the physical price start telling two different stories, and that is exactly what we are seeing right now. Now let me connect this with the data we have been discussing throughout this week, because the Shanghai premium is not appearing in isolation. It is the result of several pressures building in the silver market at the same time. Over the past few weeks, geopolitical tensions in the Middle East have intensified dramatically. Energy markets reacted immediately. Oil surged from roughly $70 per barrel to above $119 at one point during the volatility. Commodity markets began experiencing large swings, And in the middle of that chaos, something very quiet but extremely important happened inside the silver market. Large quantities of silver inside COMEX vaults were moved from deliverable status to non-deliverable status. In addition to that, major institutional buyers continued accumulating large amounts of physical silver during price pullbacks. At the same time, open interest in silver futures contracts remained extremely high relative to the amount of metal registered for delivery. To simplify the math, there are tens of millions of ounces classified as registered silver inside COMEX warehouses. But the number of ounces represented by open futures contracts is several times larger. That imbalance is not new, but it becomes more important during periods when more traders choose to take actual delivery instead of rolling their contracts forward. And recently, the percentage of contracts standing for delivery has been significantly higher than what markets normally see. Again, I want to be very careful here. This does not mean the exchange is about to collapse tomorrow. COMEX has mechanisms that allow contracts to settle financially rather than physically. They can adjust margin requirements. They can modify delivery incentives. In fact, margin requirements for silver futures were already raised sharply earlier this month. Those types of actions are designed to reduce speculation and lower delivery pressure. But the existence of those actions still tells us something important. Healthy markets usually do not require emergency adjustments. Healthy markets usually do not display double-digit price gaps between major global exchanges. So something inside the silver market structure is clearly under stress. Now, I want to explain why this matters specifically for people who hold physical silver. If you own real metal, coins, bars, rounds, anything tangible, you are holding the asset that industrial buyers and investors around the world actually need. The price on your screen may say $84. But in other parts of the global market, buyers are already valuing physical silver at a significantly higher number. That disconnect can feel confusing for retail investors because we are conditioned to treat the screen price as the ultimate truth. But the screen price is simply the futures market price. And futures markets do not always reflect physical supply and demand perfectly in real time. Now let us zoom out to the weekly picture, since today is Friday. At the beginning of this week, silver was trading around $83. Midweek, it briefly touched $90 during volatility. Then it pulled back again toward the mid-80s. Looking at that chart alone, it might appear like silver went nowhere this week.